Welcome to the next episode of the Betterwallet Podcast. Today, we're going to bring on Kevin Matthews from Building Bread. He's an award-winning author. He is a financial educator. He has a very unique perspective on the world of investing, given that he was born and raised in Tulsa, Oklahoma. Why is Tulsa, Oklahoma important? You'll learn about that during the episode. What you're going to learn during the episode is that you're going to learn how to build wealth in today's market, number one. And number two, how Kevin's going about building wealth for his family. So make sure your notepads are ready. Let's jump into the episode.
Welcome to the Betterwallet Podcast, a podcast where we talk to everyday people who have changed their lives through managing their money. We talk about their money journeys, the good, the bad, and the ugly.
Welcome, everyone, to the next episode of the Betterwallet Podcast. As you guys know, the Betterwallet Podcast is all about demystifying the topic of money and sharing powerful money stories from people who truly beat the odds. Today, we are blessed to have Kevin Matthews on the line, the one and only from Building Bread. And today, we're going to talk more about how to budget, how to invest during a time like today where the market is volatile, things are going crazy. Layoffs are happening. We were just talking before the recording. There's some layoffs that's happening in Kevin's industry, and it could be kind of scary. So we're going to talk more about that. But if you don't know who Kevin is, you need to find out. As I mentioned, he is the owner of Building Bread. He's helped thousands of people invest with confidence. He's a three-time Plus Award winner. I remember being like in the back and you're receiving all these awards. I was nominated for one. Like, and I don't know how I got nominated, but I was nominated for one. And I was like, maybe I'll win. And then like Kevin basically was up there the entire time, just getting his award for like all the accomplishments he's had. And I couldn't be more proud because it's rare when you come across someone that speaks your same language and understands like the same things that you understand, is like on the same mission as you. So it's an honor to have you on the podcast, and it's an honor to hear from you, man.
Yeah, thank you so much for having me.
For sure. So before we jump into budgeting and investing, let's first do our icebreaker question, which I didn't prepare you for. And that icebreaker question is, what is your biggest financial pet peeve? I'm sure you have plenty. Just watching your YouTube, I know you have. What's one? I think that's the hardest part, right? Like figuring out one, not necessarily figuring out what your pet peeve is.
Yes, which one is it today? My biggest one is always the, perfect credit score over $1 million question. And people always say, oh, I'll take the credit score because I'm going to borrow money and then like borrow $1 million and make it 10 million. And I was like, well, if you just, no, that's not how it works. So that is always the one. It's been that way for like 5 or 6 years. I don't know why we keep falling for the wrong answers.
Yeah, it's crazy. There's so many people out there that just their credit could be screwed up like the hell and back, but they, for some reason, believe that they can get business credit and it's all going to be better.
Yeah.
And I'm like, no, like take care of your house first and then start focusing on the business. Because like, in my opinion, it's riskier to do it with your business because you can go bankrupt if you really screwed up, like you're going to prison, like you can, if you screw up your books, like you have some employees working for you, like it's a bad road to go down. At least if it's personal, it's just you.
Yeah.
So yeah, it's quite interesting. I love having that debate. Because I mean, give me $1 million and sure, we can just put it into the market and let it grow. But the chances you're going to take it to 10 or 100 million, like, okay.
Right. If you had that skill already, then you would take the 1 million for free because you're not paying interest on it, and you would do the exact same thing.
Right.
But I just feel like the credit score, while it is important, I feel like it's the most overrated financial stat. Like it is not a magic bullet that solves everything. And people forget, like you got a perfect credit score, they're still not giving you $1 million, right? It's based on your income, and they're going to look and see like, hey, you're only getting this much, right? So yeah, I don't know what it is. Again, the most overrated financial statistic out there.
Yeah, it's interesting because like when people ask me, what did I learn about finance growing up? I didn't learn much. But one thing I did learn about is that you can't get anything if like your credit score is like trash. So it's interesting that it's still like a topic and you learn about your credit score before you actually learn about investing. And then you start over time, you start unraveling like what a credit score really means. And for me, my credit score is good, but like to your point, it's not a metric that's all too important if you don't plan on actually taking out any debt. Like I don't plan, like I'm at a point now where I don't actually plan on taking out debt unless I get a mortgage, which I plan on renting for a good amount of time before I actually get a mortgage. But like my next car will be likely in cash. I mean, I don't plan on getting any more credit cards unless I really need it. So it all comes down to when you actually need the credit. If you don't actually need the credit, then your credit score is somewhat irrelevant. So it's kind of fascinating. That's like the only thing that we learned about like growing up as it relates to money management is your credit score and not knowing that, or your credit score and the fact that you just didn't have any money, at least for me. So let's get into just your story, man. Like we're talking before the episode, you were born in Tulsa, Oklahoma, Black Wall Street. For anyone who's like, okay, what is Black Wall Street? What is that? Like, what does Tulsa, Oklahoma have to do with Black Wall Street? Kind of break it down really simply for anyone who's like, I have no clue what that is.
Yeah. So again, for those that don't know, I was born and raised in Tulsa, Oklahoma. It was the heart of Black Wall Street. And this was in the early 1910s and 1920s, where this was the very beginning of Jim Crow, the height of the decay, and Southern white racism in the worst flavor at that point in time. But in the business district of Greenwood inside of Tulsa, it was an all Black community. It was one of the wealthier communities in the US at that time. And what made Greenwood special is that, remember, you're thinking like sharecropping. Obviously, there was no tech at that time, at least in the way that we think. But Black people could go get a decent job and actually move up the income and wealth ladder in Greenwood. And at that time, that was not a thing in the early 1910s. It was definitely not a thing in the early 1920s. So it was really the first all Black district where you could have people start from nothing and actually move up through the income ladder in ways that were historic at that point in time. So in 1921, there was a massacre that literally burned that entire district to the ground. And North Tulsa now, the Greenwood area, is still recovering in some ways, but it was historic at the time. It's still historic to this day, and we're still learning a lot of lessons from that era.
Yeah, no, absolutely. And if you guys are looking to learn more about it, I'm somewhat ashamed I didn't learn about it until maybe college time frame. But if you want to learn about it, and I think you should learn about it, like just go to Google, type it in, and just read everything that happened. I mean, Kevin really, like, he brushed over a lot of what happened during that time, but it's a shame. Like, and he used the correct word, being a massacre, and they made all types of excuses on why it should have happened and why they burnt down all the buildings and everything. And there's unfortunately a lot of people that believe that it never happened, which is crazy. So read up on that and learn something about American history with that. So, Kevin, I want to learn a little bit more about your background. So, born and raised Tulsa, Oklahoma. When did you get to the point where you said, okay, well, I want to start teaching my own folks or, the community or the world about finance and how to manage money?
Yeah, so there are two parts to that question. The date was 2010. I remember that distinctly. But it starts, so like you mentioned, growing up in Greenwood had a very big impact on me because that's what really sparked my interest in money and in wealth creation, because I grew up here and hey, our community, our people had so much wealth. I'm looking around like, it's been 80 years. Where is it? Right. As I'm growing up, and now it's 100 years at this point in time. I'm like, well, how do you build wealth? So that was my burning question as I'm growing up, going to school and all that kind of stuff. And then 2010, had my very first internship on Wall Street at what was then ING Investment Management. I think it's now Voya. Yep. And at that point in time, I'm literally on Wall Street, hey, here's stocks and bonds and mutual funds. I'm like, what is all this stuff? So as I'm sitting here struggling as an intern, it wasn't until it was a 10-week internship. It wasn't until week 9 that it just hit me. I'm like, oh, I understand all this stuff. Why were y'all using these ridiculous terms? Why were y'all using these complicated charts? Y'all could have sat down and just talked to me in super simple terms, and y'all were overcomplicating it, leaving me in the dark for 9 weeks. So at that point, I was like, look, investing is amazing. I need to teach people in a way they can actually understand and do something about it. So from there, I started BuildingBread, and I started in a dorm room. Hey, look, y'all need to learn about investing today, and started doing that ever since. And it's just kind of been my mission to really simplify investing and make it accessible.
Yeah, and I'm sure you change a lot of lives with that, man. Like I was looking, you've helped thousands of people design their portfolio, invest with confidence, manage their money with confidence just in general, man. So, I want to make sure I'm giving you your flowers during the episode, but you're right. I mean, if you don't know, or if you have a misunderstanding of investing, you can fear it. And a
Mhm.
lot of what I talk to my students about isn't necessarily like, I talk a lot about, hey, here's how you go about investing, but a lot of it is unraveling what investing really means and
Yep.
making it really simple and straightforward. So I love the fact that you're doing that as well, and you made that your mission. So you're in college and you're teaching people how to invest. You did your internship, you learned how to invest. When did you get to the point where you said, hey, like, I want to go and build this company? So you built it in a dorm room. And when did you get to the point where you just wanted to take it online and teach the masses outside of like the college dorm?
Yeah, I initially started with a terrible website back then. And I don't think it was till maybe 2014 or 2015 where I really sat down and said, hey, like this can be a much bigger deal. And I can like really impact lives a bit more than what I was. And what helped me to do that is, I graduated and got a job. And all my friends got jobs. So it stopped being like this theoretical thing about investing because nobody really had a job at that point. We're all eating Taco Bell at the 89-cent menu, struggling. So it's kind of hard. Like, hey, you should invest. And at that time, there was no, like Robinhood didn't exist. Like investing on an app wasn't a thing in
And
2010.
expensive too. Like getting
Yeah,
one was like $3,000 to get into it.
exactly. And then like if you're a college student, you're like, okay, $3,000, I gotta go like log into my computer and do this stuff. This really didn't really click.
Right.
But by 2014, 15, it became more popular. All my friends had jobs then, right? And they actually had money to manage. And that's when I realized like, oh, we really need to like build out something here. We really need to like talk to more people and build more of a community around it. So it's really, I kind of happened to be ahead of the curve and really just everything kind of caught up to where we were. And, things fell into place.
How do you teach people how to go about investing when you have all types of bills, you have debt? Like, how did you get them to prioritize investing with all the other things that they need to think about as like recent college graduates?
Yeah. So what I do is always focus on the long term, right? And it's really about what you build now is going to be that foundation of what you're going to have in the future. And the way that I couch it sometimes is say, look, 30 years from now, you're going to wish you started 30 years ago. Everybody says, oh, I wish I would have invested in Apple in 1990. I'm like, hell, we all do, right? We all want to, but the only way you're going to get to that point is if you start now, whatever, if it's an index fund or a stock or whatever, but you have to start somewhere. And what I also tell people is like, it doesn't matter right now, whether it's $10 or $100 or $1,000, start somewhere and you can improve on the back end. But the most important thing is just to start, get the ball rolling, and you can come back and add more as you go along.
Amen to that. Yeah. I mean, when it comes to investing and even paying off debt, I mean, when I was paying off my $8,000 of debt, I had no clue how I was going to attack it. And I didn't really have the best strategy, but I knew I needed to do something. And it started off with paying $10, $100, $50 sometimes. I did the snowball method, then I did the avalanche, I did a hybrid, then I had days where I was just like, I don't feel like paying it off. So you have to start somewhere when it comes to debt, when it comes to investing, and brick by brick, you'll get to exactly where you want to get to, but it might take some time, but it takes more discipline than anything. So you build BuildingBread. Obviously it's been wild success for you. Like we're now in this like technical recession, right? You have these layoffs happening. People want to invest, but then they have a lot of other conflicting obligations, right? We're struggling because of inflation to put food on the table and groceries and things like that. Let's talk through like 3 ways to navigate this world that we're in today. Like if I were someone and I said, hey, Kevin, like I'm really struggling with my finances and I really want to get my finances in order, what would be step number 1 of getting your finances together?
Yeah, so that's a great question. For me, it's always laying out like what is it that we're taking care of? Like what is it that's out there? And I feel like for most of us, it's always like rent or mortgage is that first hurdle. So it's really starting there and going backwards and listening, like where is my money going? And then what are some things that I can shift around? Or do I just need to increase my income in some way? So that's the first thing. Like, where is it going? How much am I bringing in? And figuring out what that difference is, if there's a difference at all. So just sit down and lay everything out first, and then you can start making a plan for steps 2, 3, and 4.
Right. So yeah, I mean, that's a huge step, right? Like a lot of people can tell me how much money they made last year or even last week, but no one can actually tell me like how much money they spent yesterday,
Exactly.
right? And that's like the biggest challenge. And I'm happy you brought it up because there's a lot of people who are just like, oh, you can like frugal your way to wealth. And it's like, it doesn't work that way. Like at a certain point, you do need to increase your income, but it's much easier to decrease any unnecessarily, wants, if you will. It's easier to do that than to actually increase your income. But if you do both, like that formula will help you to become rich over the long term. So step number 1 is understanding like where your money is going, have a spending plan, understand how much money is coming in as well. What would you say step number 2 is to gain your finances in order?
Step number 2 is that difference, right? Is there a deficit where we're saying like, hey, we're not earning enough, or am I just spending more than what I expected? And then you target that, figure out what that number is, it's positive, negative, or so on and so forth. And then say, all right, we need to make an extra $500, or we need to reduce spending, $500 or whatever that number is. But the only way you can get there, lay those expenses out. Step 2, figure out what that amount is. And then you move on to step 3 and figuring out which area do you want to attack. Is it easier for you to cut out a specific expense, or is it easier for you to negotiate for a higher salary, perhaps look at a new job or even a side hustle to cover that gap?
Absolutely. No, I totally agree. And if you want to get to your end goal quicker, you have to do the combination of the two,
Absolutely.
like figure out what your expenses, like what expenses you can actually cut, and then also increase your salary. That's going to help you like increase your overall discretionary income, which is your income minus any expenses that you have, not just bills, but also, if you want to buy a new pair of shoes throughout the month. And then when your discretionary income is higher, that is going to be the overall factor is going to help you to decrease debt and to invest. And I always tell people like, hey, like paying off debt is great. And I want to say the budgetista says this all the time that like, paying off debt is not like it doesn't equal wealth. But as a community, what's going to be important is that we not only get to debt freedom, but we also start to invest our money in order to help it grow. Because that's the only way that we're going to help close the wealth gap. So for anyone who's like, hey, like I want to start investing, but I don't know where to start, there's a lot of different ways of going about starting. You have YouTube University, you have Google University. I mean, you have Kevin with his whole entire platform. You have my platform where I'm teaching you how to go about investing. Like the resources are out there. You just have to start, as Kevin mentioned before. But I think the challenge right now is that there's so much information online. There's so much information on social media about the right way and the wrong way to invest. And this might be one of the pet peeves that you didn't mention earlier today, but like, what is the wrong way to invest in your eyes?
Ooh. So the wrong way is through these crazy insurance policies that people are talking about left and right.
We just had a full episode on that.
All right, so y'all, if you haven't heard the episode, I'm gonna have y'all refer to that one. So I'm not gonna take that one. But I would say that the wrong way to invest is by going all in and trying to make money overnight. And that's what I see people do all the time. To use a sports reference, I mean, it's like you trying to dunk from the 3-point line on every shot. Like, bro, what are you doing? It's probably not gonna work.
Exactly. And especially if you haven't played basketball anymore, or you haven't played basketball.
That too.
It's like, all right, well, I'm just gonna get on the court and I'm just gonna, dunk it like straight off. Or it's like someone who doesn't run ever and they're like, I'm gonna run a marathon tomorrow.
Exactly.
It's like, not gonna happen, brother. So but yeah, I mean, it's one of those type of things that people want to get rich quickly. And after hearing everything about NFTs and everything about individual stocks, everything about, I mean, you name it, like there's so many different strategies out there that we've heard of over the last 2 years, 3 years. No one we know, no one has become a multimillionaire from it. Even after everyone's saying this is how you're going to get rich. Like no one has. But you know how many people that I know became index fund investors over the last
Yes.
a lot. In fact, a couple of them are like they threw in the towel and they're fully retired at this point, which, kudos to them. And, that's my end goal. So we're talking about index funds, and I know that's like something that you talk about often, but how would you define the right way to go about investing?
Yeah, so the right way is through index funds for 99% of people. I
Mhm.
also think the right way to invest is to take it slow and cover the basics. I think that's the other part of it that's the wrong way. Like I think there's so many people who want to start off on like the expert end and the most difficult way to make money. It's like, why don't we cover the basics first, right? I remember 2017 was like that first big Bitcoin wave. And a
Mhm.
barber who was giving me a haircut was like, man, you investing in Bitcoin? I was like, I don't really know. But like, have you invested in Nike? Have you invested in like an index fund? He said, nah, man, stock market too risky. I'm like, bro, what?
Yeah.
I'm like, hold on.
Can
So
we
like,
talk about that real fast? Because I think people get the levels confused.
yeah.
And they always think that the riskiest strategies out there, they think that is investing. And a lot of time it's gambling because you don't know what's going to actually happen,
Mhm,
relying on chance.
right.
And to break it down for anyone who's like, okay, what is the spectrum from like the least risky to like the most risky? The
Mhm,
least riskiest thing that you can do is like having your money in like treasury bonds, where actually before that you have just cash. You have your money in a cash, like a money market account, right? You can't expect for it to grow, but you should be very confident that it's not going to lose any money. Then you get into like treasuries where it's basically backed by the government, which the government is not going anywhere anytime soon, even with all of the political turmoil that I feel like we're going through right now. And then like, and I'm skipping a few on purpose, but then you get to the point where, you're investing, more diversified, right? Like, so you go into like index funds and, mutual funds, ETFs, right?
mhm,
Those are because you're so diversified, you're owning 500 plus different stocks. It's really hard for you to lose money over the long term. I think the number is actually like after 10 or 20 years, the chances of you losing money in an index fund is zero,
mhm,
which there's no guarantees in finance, but that is one of them where they say because you're so diversified, the chances that capitalism isn't profiting after 20 years
right.
is zero. Like, it's a really bold statement, but it's true. But then I feel like a lot of people, they start on the opposite side of the spectrum and then they coin investing being risky. They go into the things that they hear about online, like crypto or, specifically like Bitcoin and Ethereum or trading options, penny stocks.
Yeah.
Like I would never forget one of my buddies, his name is Kyle. Hopefully he's listening to this. I won't give you a last name, Kyle. But Kyle, he called me when some penny stocks were taking off. It was back when money was basically free in 2020. And he was like, hey, I want to put, $10,000 in this one penny stock. Like it's going to take off. And I'm like, Kyle, like, no, like you don't have to believe me. I don't really care, frankly, but like as friend to friend, like if you're gonna talk to anyone about investing, like you're gonna talk to me. And like I know a few things, and you probably shouldn't do that. He went off and he still did it. He still did it. And he lost the majority of that money. But that's how most people start off
Mhm.
is by not really knowing what they're doing. And I'm happy for you and I where we're helping to save people before they even get to that point. But I think a lot of people, they start off with the options and the crypto and the penny stocks and all that stuff, and all that's gambling. We're trying to teach you how to go about investing and building long-term wealth.
And the problem with that, as you mentioned, is there are some people who go big into a penny stock or something. We all saw what happened to GameStop and
Yeah.
AMC, right? The issue is when that happens and you get that sugar high and you just happen to be right, that becomes your baseline expectation,
Yep.
and you think everything is supposed to work that way. And then you don't
Exactly.
realize, like, oh, wait, everything's not GameStop. Like, I've seen so many people since 2020 invest in like Peloton, which is down 97%, and just
Mhm.
think, oh, it was $2. I thought every stock that's $2 shoots up to 200 in 3 days. It's like, no, that's not how it works. So you got to be real careful because most times it's not going to work. But even if it does on the off lottery chance, and that's the thing too, people invest like it's a lottery ticket, which is not the way to go about it. But you got to be careful because if you set the wrong baseline expectation, you're going to keep shooting for the moon over and over again and run out of money
Mhm.
because 99% of the time, that's not going to work.
Exactly. And it's definitely, you use the right term, like a sugar rush.
Hmm.
And I think the other thing that makes it really difficult is that they're following these people, online that, they might trust. And that person might say, oh, I just made $1,000 in 1 minute because I invested into whatever. Ask that same person what their net losses are. Because if
Yep.
they're going and they're trading and they're making $1,000 in a couple of minutes, best believe for every one time they got it right, they had 9 times out of 10 that they got it wrong. But
Yep.
they won't tell you about that.
Hmm.
And, you have Kevin and I who actually give a damn about your finances, and, we're out here just trying to preach that gospel. But there are a lot of people out there that don't really care as much, and they just want to get rich off of you, which is, incredibly unfortunate. But yeah, you want to go about investing the right way, guys, long term. Don't gamble your money, because again, like, the only way we're going to close this wealth gap is if we invest the right way and we teach our kids how to go about investing, and then we go and invest for them as well, which I think brings up a really good topic. I know you have two little ones. Like, how are you going about investing for your children?
Yeah, great question. So right now for my two kids, we have the 529 college savings plan in case they go to school, if college still exists at the point in time, which I think it will. But we're doing that, and then we have custodial accounts for them as well. So when they turn 18, that money will be theirs, and they're already way richer than I was when I was their age, and they've got more money at 5 and 3 than what I had at 18, and I had a job.
Yeah, no,
Um,
definitely. Yeah, you're
so
saying it
yeah.
the right way. So for anyone who's like, okay, what's a 529 account? You guys are talking Mandarin to me, right? A 529 account is a tax advantage account for college or even all things higher education, where you put the money in after tax, the money grows tax free. You take it out for qualified expenses like laptops and tuition, like if you private school, and you don't have to pay any taxes on that. For anyone who's late to the topic, you might say, okay, well, why is that a big deal? You compare that to a brokerage account. You put the money in after tax, the money grows, and then you take the money out. You have to pay taxes on whatever growth that you have, right? Uncle Sam says, like, I want whatever the percentage is, 25%, and take it or leave it, right? With a 529, you get to keep that percentage, and for a big sum of money, that could be thousands of dollars.
Mhm.
Especially, with Kevin, he's investing. His children are younger; they're going to be 18, within the next 15 years or so. Like, at that point, they're going to be able to take that money out. It's going to be a big sum of money, hopefully. And then when you take it out, you're not going to have to pay any taxes on it, assuming that you're using it for higher educational expenses. And then the other one you mentioned was was it a custodial Roth or a custodial brokerage?
Just a custodial brokerage right now.
Yep. So with that, it's, a brokerage account that, is called custodial because so Kevin owns it, but it's for the benefit of the children. So people don't know that you can invest for your children. You can invest for your children before they're born. You can invest for your children before they're adults. And that will give you 18 plus years of growth that otherwise you wouldn't have. I think a lot of people,
Exactly.
they wait until, the child's 25, 30, and when they say, okay, well, they need to go invest, but you could have given them a 25-year head start if
Mhm.
planned, or if you just started with a smaller amount. That's what I'm
Yeah.
doing for my
And
kids that don't exist yet.
and that's the thing. So like the majority of people, just like let's just say, the cookie cutter finance advice, right? You go to work, you invest for 30 years and you retire at 65.
Mhm.
Well, what if we took a shortcut, right? And for the first 20 years of life, I'm going to go ahead and start it. And then for the next 10, they do it themselves and they're done at 30,
Right.
right? But that's the thing. By starting really early is a way that we can help close the wealth gap and get things started before and really set them up in a place where I would not have imagined at that age. And the thing is, I don't think enough people realize is the way the math works, the sooner you start, the less expensive it is.
Right.
So because you're starting at age zero, $100 a month can add up real quick. But if
Yeah.
you're starting at 35,
Yeah.
$100 a month is not going to do what you need it to do. It's going
Exactly.
to cost me a whole lot more to really get to where I want to be.
Exactly. You can literally and at a certain point, I mean, you could put $100 a month in for this child who doesn't exist yet, or maybe they're here now. Like $100 a month. At a certain point, you don't even have to contribute anymore because
Mhm.
the money is going to grow. and you get that compound interest. And if you follow my page, like I talk about all the time, and I literally write down a notepad where if you put money away for like $100 a month from the age 0 to 18, at 18, you can stop. And then by the time that they turn 30, they have stacks of money. And God, like when they turn 60 and they want to retire, they don't even really need to have a retirement portfolio.
Right.
Because they already have it because you started when they were younger. And I encourage parents and aunts and uncles like to put money away, even a small amount for birthdays. And like, sure, you can go and buy them a gift as well, but buy them a gift and buy them a gift for the present and buy them a gift for the future as well.
Yes.
They won't understand it right now. But God, like if I turned 30 and my Uncle Frankie told me like, I had an investment account for you, like for all this time it's been growing. And oh, by the way, it's $100,000. Like imagine what I could possibly do with that. That could be my first real estate property. That could be, more money into the stock market. Like the opportunities are truly endless if you have like 6 figures already invested at a younger age. So yeah, thanks for walking through like how you're going about investing for your kids. With that, Kevin, I don't want to hold you too much longer. I know you have a lot going on, but if anyone's like, hey, where can I find Kevin? He really knows his stuff. Where can they find you online?
Yeah, you can find me on all places social media at BuildingBread and at buildingbread.com. Whether it's YouTube, we post brand new videos Monday through Friday, 250 videos a year is what we do on YouTube. And you can catch me on Instagram, TikTok, Facebook, and Twitter.
All over the place. I love it. So guys, make sure you're tapping in with Kevin. I'm going to make sure all those links are in the show notes. But with that, Kevin, I appreciate you coming on. And that is the end of the episode. And I'll talk to you guys soon.
Thanks for having me.
Absolutely.
Thanks for tuning in to the Betterwallet Podcast. Make sure you subscribe to the show wherever you listen to podcasts. And if you found any value, we'd appreciate a rating and review.